Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, Head of UK Rate Strategy, and I'm joined today by our global market specialists, John Briggs and Giles Gale.
All right, Imogen, we've got to start with you this week because we are recording just after the Bank of England, where they surprised a lot of people, I would say, not necessarily everyone, but a lot of people, and dare I say it, us included, by delivering a 50 basis point rate rise after the pretty awful CPI data that we had yesterday. So can you just talk us through what we've learned from all of that?
Yeah, I think it's actually my own fault. I'm pretty sure I sat on this podcast last week and said that because it wasn't a quarterly meeting, the scope for surprise from the Bank of England was much more limited than what we'd seen from the Fed and the ECB. But in the end, they did surprise. As you said, Giles, we got a 50 basis point hike versus expectations, certainly consensus amongst kind of economists and analysts for 25 basis points, even after the upside surprise on inflation. The market was a bit more mixed, but it still wasn't really more than 50% priced for a 50 bip hike. So broadly speaking, it was a surprise. And it wasn't just the hike itself, but there are a couple of things that made this what I would call a hawkish hike, and what really felt like a bit of a shift, to be honest, in the Bank of England's reaction function. Obviously, the size of the hike was hawkish in and of itself, but also the vote. So it was a 7-2 vote in favour of 50 basis points. The two that dissented continued to vote for unchanged rates. But that's a pretty decisive vote in favour of a step up in the pace of tightening. And perhaps one thing that's worth noting is that one of the votes for unchanged rates was Tenrera, who, as we know, will be stepping down. This was her last meeting. She steps down in July and will be replaced by Megan Green, who had a bit of a grilling in front of the Treasury Select Committee last week now, I think it was. She didn't give much away, but it feels perhaps like she's more likely to vote with the consensus rather than to be a dovish dissenter. So that adds at the margin another layer of hawkishness, I suppose, in that one of the dovish dissenters is likely to be replaced by someone that doesn't vote dovishly. The forward guidance around the direction of travel of rates was unchanged. There's still this kind of asymmetry on the rate outlook that they talk about. If they see more evidence of persistent inflationary pressures, they will raise rates further. But there were a couple of sentences, I think, in the minutes, which felt to me a little bit like an ECB style shift that we had last week, where although it wasn't a quarterly meeting with updated forecasts, they almost, not in so many words, sort of said that they didn't necessarily believe what their models have been telling them for some time. So just to read out those sentences, because I think they are pretty key. They said that the MPC recognises that the second round effects and domestic price and wage developments generated by external cost shocks are likely to take longer to unwind than they did to emerge. And there has been significant upside news in recent data that indicates more persistent in the inflation process against the background of a tight labour market and continued resilience in demand. The minutes then go on to say that there are some indicators of future pay growth and goods inflation that have weakened, but their properties as leading indicators had not been tested in a similar period of high inflation. So it really felt to me like a hawkish shift in the Bank of England's reaction function rather than a kind of one and done 50 basis point hike.
Okay, I quite like the readings there. It was sort of channeling Lagarde, but to great effect. Okay, so I guess you sort of led into my next question by talking about their reaction function. Now the market is pricing in, what is it, something like 6.1% now or something like that as a terminal rate. Now, I guess one way of asking this is that fair or is that not fair? And for you, has something actually really changed about the way that they're approaching this? And if so, what does that mean?
Yeah, I think that this is a real change in their reaction function. They didn't pitch this as a kind of one and done. We're hiking more today to get to terminal rates sooner. I think that actually market pricing of around 6% peak in bank rate feels fair now, to be honest. So we've kind of materially revised our bank rate view, where we previously had a peak of 5% in August. And although we recognize the upside risks to that, and the upside risks clearly with every data print that we've had over the last couple of weeks that has surprised to the upside, we're just increasing. But nonetheless, 5% was our base case, and well, we're there today. So it definitely warranted a bit of a rethink of our view. We now see terminal rates at 6%. So that's another 50 basis points in August, we think. And then another 50 basis points of tightening, essentially delivered by November. At this point, it's kind of difficult to assess whether that would just be a third and final 50 bip hike in September, or as we do get closer to that peak, they kind of step down again to 25 bips and do 25 in September and 25 in November. But this, for us, that's kind of a bit of a mark to market of our views. Clearly, the market has long been on the more hawkish side of the Bank of England. And for the first time in a long time, it feels like the bank has kind of stepped into that that same hawkish terrain as the market. Previously, the bank has kind of pushed back quite heavily against market pricing and suggested that on the market implied path of rates, inflation would be well below their target at the 2 to 3 year horizon. But today's meeting seemed to validate those expectations. So, market pricing seems pretty fair at the front end. The only other thing I would add, I guess, with regard to our Bank of England view, we discussed last week this idea about whether they could pause or potentially slow down QT. I think that this just makes that even more unlikely. It was my base case anyway that wouldn't happen. But to the extent that, they clearly think they need to do more tightening now than they previously did. And for all that they dismissed that QT has a real market impact or is tightening, it is tightening, and it just works via a different channel to bank rate. It works via a channel that they're under a lot less public criticism for. And therefore, I think to be able to tighten on a tool that you're not being criticized for would probably be quite welcome. And the pace of active sales, I think, can continue into next year.
Okay. So, I guess for me, maybe this is the first Western central bank that's really just capitulated and said, okay, now, although they haven't, clearly they're not putting it quite so bluntly, but maybe this is just an acceptance that the only way out of this high inflation dynamic that we're in is a recession. So you might as well just, they say in the States, rip the Band-Aid off and get on with it. So first of all, I'd ask, do you agree with that? And secondly, just given everything you just said about QT and the bank rate path, just sum that up for us in terms of your market views now.
Yeah, I don't disagree. I think that this more clearly puts the economy on a path towards a kind of deeper and more prolonged recession than we previously thought. I mean, it wasn't all that long ago that you had Broadbent warning about the risk of a 5.25% bank rate. He said that cumulatively over the tightening cycle, if bank rate were to get up to 5.25%, you would have a hit to GDP of -5%. So, it was a real kind of stark warning, albeit against the different backdrop of concerns back in September and October. But, I can't believe that the assessment has changed all that much, that somehow rates at, 6% wouldn't tip the economy over into recession. And of course, one of the reasons why we'd long been on the more dovish side of the market was to do with this lag transmission mechanism of monetary policy that we think is starting to work, but is taking a long time. That lag transmission also works on the downside. So at the point at which they would like to start stimulating the economy, it becomes harder to do, because if you fix your mortgage today at 6% and lock that in for 5 years, you don't kind of feel that easier monetary policy on the downside. So yes, slower growth for a longer period of time, or even negative growth, I should say, for a longer period of time feels like the kind of obvious takeaway, I would say. For markets, what does that mean? It's not necessarily clear to me, because I think that the hurdle to easing, even in the downturn, is still higher now than it has been in previous cycles. So although we've raised our peak level of bank rate, and we think that that occurs later than we were previously expecting, we haven't brought forward our cut profile. So we don't think that they pivot any quicker. Well, slightly quicker given that the peak occurs later, but we haven't brought forward our cuts essentially. So although the market is kind of fairly priced for the peak in bank rate, I actually think that front-end yields could be a little bit higher than here. We're at about 5% in 2-year gilts. If bank rate can get to 6% and remain at that level for kind of 6 months or to a year, and then you get, a cut or two, I think that 2-year gilts could be closer to fair at maybe 5.3%. And the reaction that we saw in the market today was that kind of repricing slightly higher in front-end yields, but then longer dated yields rallying, exactly to your point, Giles, around these concerns about a recession. But I think that for longer dated yields, actually, it's a little bit less clear-cut than that, because yes, you have recessionary risk, but to the extent that a large rise in gilt yields that we've seen in the last couple of months has been about this kind of supply-demand imbalance, this lack of demand from the natural buyers, which has been driven in part by this kind of lack of confidence around how quickly inflation might be coming down and how fast that downward trajectory might be. I think that this week's data and reassessment of bank rate views only kind of pushes that point at which the demand returns even further into the future. So I'm comfortable, even with kind of increased recessionary concerns, that we can still get higher yields from here further out the curve. So we keep that 4.6% target in 10-year and just slightly raise our profile for front-end yields. I think that's probably enough on the UK now. Let's move over to the US. I guess it wasn't all about the Bank of England. There were obviously other central banks going on this week too, but we also heard from Powell off the back of last week's meeting, where they slightly surprised in terms of the dots and the projections, but didn't surprise in terms of the rate action that they took. Did we learn anything new at all from Powell this week, John?
Not really. I mean, Powell, for the most part, reiterated a lot of the commentary that came out of the statement. The one difference, I think, between last week, because we had a slight up move in yields during his testimony, partially because of thanks to our friends across the pond, thanks to that Imogen, and the ongoing sell-off and rise in UK yields, which is reasonable, especially in the front end, given the inflation outlook and the actions from the Bank of England. But the last week, there was a little bit more mixed because the Fed decided to pause, but then signaled a rate hike. So he was getting challenged from reporters about, well, why didn't you just hike now? If you think you need higher policy now, why aren't you doing it? So in a way, for the first time in a long time, Powell actually had to defend the policy action from a dovish side. Like, we're pausing because we want more time. We're pausing because we still want higher rates, we still think higher rates are necessary, but we decided to wait because. So that was more of a kind of like dovish defense, whereas in the past, it was always, they was getting challenges on why you keep hiking rates, so they would tend to be hawkish defenses. Now, this time around, Congress didn't really ask too many deep questions or probe too strongly on that. So he stuck mainly to what was the rhetoric from last week's more hawkish statement. So, like I said, we've had more of a spillover effect from overseas markets as much as anything. We've had a pattern where we've tended to, move higher in yields, tended to flatten a bit, and then when the UK goes home, we have a bit of a recovery, and we've seen some decent demand for like the 20-year auction and some other indications. But it's going to be hard for any major government bond market to not be influenced at all from other foreign sovereign markets when they're moving to this extent. So not much new from Powell. I would say on the margin hawkish, but not game-changingly so, and as much susceptible this week with a pretty late data week to overseas moves as much as anything.
Yeah, that makes sense. I guess thinking about that dovish defense from Powell, that sits more closely with our view that it is more dovish than markets are expecting, where we don't think that we get a hike in July. We think that actually the peak could be in from the Fed now. Are we still looking for that? I know that that's what we were thinking last week. Is that still our base case?
Yeah, it's definitely not consensus because the market's pricing 70% for July right now. We were in a similar situation 3 or 4 weeks ago, and we also had a counter consensus, no call for June. Now, obviously, the Fed is guiding to pretty strongly towards July hike and one of two for the rest of the year. So this one might be a little bit more of a challenge, but we do have a fair amount of data between now and the meeting. And, he has cited data dependence, and they could continue to evaluate. He doesn't like the word pause, but, evaluate the situation if we do have further deterioration. I will note that on that front, next week, we have a core PCE deflator, and we ourselves have a pretty decently below consensus call where the consensus is somewhere around 0.4. I say somewhere around because if you look at the unrounded, they're probably high 0.3s that round to 0.4, not like a 0.44, it's like more of a 0.38. But given the PPI and the CPI data that we had just gotten, we actually moved our own forecast from a 0.31 to a 0.264. So that's almost a 0.2. So we are interestingly quite below the consensus output. So that would be a good first step, I think, to at least perhaps before payrolls, putting a little bit more balance in the outlook. I think the U.S., we talked a little bit about spillover from foreign governments of bonds into our bond markets into ours, but I think the U.S. is a very different situation from the U.K., even though, both Anglo economies where, yes, we have inflation being sticky, not coming down as fast as we like, but also a lot less on the supply shock type side, particularly the domestic labor market, without Brexit dynamics and other things that probably are better suited for another podcast. But, so I do think there are differences there. And if we do start to see inflation coming down, again, it's not going to come down as quickly as everybody likes, and we're not going to get 2% this year by any means. That could start to put a little bit more uncertainty. Now, I think I'm going to take your question and expand it a little bit as far as the Fed for the rest of the year. If we think the Fed's done and they're signaling two, I do think the market is not quite believing the dots at this point in that manner because you only have 25 basis points total priced in for the peak of the cycle. So you got 17 for July, and then you got a few more in the next meeting. So, obviously if they hike, that'll go up. But I do think that two things. First of all, if Powell's slower pace is going to be once a quarter or not once a meeting, then, there's an awful lot of time between what would be a July hike, presumably, and the next timeline, which would be November. I mean, that's an eternity in these markets. So, and it is in that post-June period, we expect to see the housing impact from inflation start to put downward pressure on inflation, which again should help the narrative, even if they do hike in July. So I think that that's probably right. I think it's going to be hard for that pricing to really move up unless we have, I was going to say UK-like inflation, but that's pretty bad. I mean, even inflation that's in the wrong direction to get that additional pricing. And it's going to be a lot easier, I think, to solidify the July hike. But then given the amount of time that passes between now and then. So that comes a little bit around to the fact that we do think U.S. yields are a little more attractive here. We do think that the front end should be getting sticky. Obviously, part of that is defined on our, lower inflation call. And even just lastly on this, the Fed is expecting their core PCE forecast for the end of the year requires 0.3s on core PCE every month between now and the year end. And we just don't have that. So long answer to your question, yes, we still have a hold in July. We realize, obviously, the market's biased to that, and the Fed has guidance to that. The data can shift that pretty easily, though, and so can Fed guidance. I mean, they shifted guidance to a June pause within 2 days. But even past that, I think it's going to be hard to get that second hike.
Yeah. I guess thinking about the market then, to the extent that, as you're saying, the UK feels increasingly like an outlier when it comes to the inflation outlook, and certainly those supply side issues that seem to be driving a lot of the inflationary pressures in the UK. But government bond yields in the UK have been what's been driving other fixed income markets. It becomes an easier sell, I suppose, to be long US bonds here, which is in line with your view, right?
Yeah, I think so. It's probably a little easier to argue on a cross-market basis, again, just given that spillover. And, we've had that view against Europe for some time now. I say it was really Giles' idea, but since it's worked, I'll take credit for it also. We'll get to Giles in a minute, let him push back on that. No, but I think that that's right. I think in the near term for the market, again, the Powell gets shifting to once a quarter or a slower pace really could reduce volatility. We do think vol can come down. we could see, I think it's going to be, since everything is so highly data dependent, a situation where we have lower ranges and you range trade with a flattening bias because that's the positive carry trade right now, less than it was, but positive carry trade right now. And then on events, you maybe steepen a little bit into that as you unwind some of that and then kind of rinse, repeat until the next thing. So very data dependent, probably a lower vol, more of a range trade kind of thing, with some minor carry dynamics within that. But still, from a larger perspective, whether you agree with us and think the cycle's over, or you disagree with us and think they could do one more, you're certainly more closer to the end than not, and still thinking about that larger picture, bull steepening type environment, which will then depend on when you think the cuts are coming, of course, but that's for another day, perhaps.
Yeah, feels like that's for a few podcasts time, probably. Okay, Giles, your turn to praise yourself for your cross-market views then. But before we get to the market views themselves, perhaps we can just talk about the ECB rhetoric that we've had this week, because they've obviously kind of continued their hawkish speak, let's say, in terms of the speakers that we've had over the past week. Is there any kind of key takeaways from anything we've heard from any governing council members?
Well, look, I mean, I always say, look at who's talking rather than so much what they're saying. But I think you can do a little bit of both this time around. I mean, we've heard from lots of hawkish sounding people. Basically, it doesn't seem like anyone has really shifted where they are. The only one on the other side was actually Villeroy, who is actually, I think, turning out to be possibly the most prominent dove on the alongside Lionel Panetta. But I guess that he has been historically kind of more indicative of or he's been someone who has occupied both sides of the argument and may eventually, whether it's because of the quality of his arguments or whether he's particularly persuasive, regardless, I think that was interesting. But the one that really stood out for me was Schnabel, who, as usual, gave a very, very lengthy speech, but it was pretty unrelentingly hawkish, I thought, and maybe I didn't put enough weight on it at the time. But one thing that stuck out from that speech was her. It was a discussion of a working paper from the IMF where she was talking about what the optimal response is if you are faced with sort of uncertainty about the persistent inflation. Again, that's quite a sort of academic central banker type way of thinking about things. But basically, what she said is that it's much better to make a mistake on the pessimistic side about inflation. Really overhit it, and then try to tidy up if it turns out that you were wrong, than to get it wrong outright. And I thought that was interesting, but today, in the light of the Bank of England, I find it an awful lot more interesting. And I just wonder whether this is the way that central bankers, particularly, I won't speak for the US here, but maybe this is a way of thinking that's in the ascendancy in Europe and might keep us on a hawkish path for a little bit longer than we as well have been anticipating. Because as regular listeners will know, we have been more on the optimistic side about the ECB path, and we've been consistently marking ourselves to market there as well. And as I look at the front end, what's priced there, I find it difficult at this stage really to strongly oppose anyone who really wants to talk about a 4% terminal rate.
Yeah, I think that feels like a fair assessment of the changing attitude, let's say, of central bankers over here. Okay, what does that mean for the market then? As we obviously, we're heading into summer. I think we always have this perception that summer is quiet months, and certainly on the European side, everyone goes on holiday. Is that the case this year, or are there anything that you're kind of watching out for in potentially, low liquidity months?
Look, I mean, no, it's always tempting to say that there's nothing on the radar and that people just go away and shut up shop and it's going to be super quiet, and it never seems to work like that. And actually, what it used to be, I guess, August, and increasingly it's July that turns out to be when risks really come to the fore. I don't know what they're going to be. All right, so let's just say if it comes around, at this point, it's for me at least, it's unanticipated, maybe one of those famous unknown unknowns, but they do seem to drop in with alarming regularity. I mean, I'm obviously thinking about the end of the half, the end of the quarter, thinking about summer trades and seasonality and carry trades and all that kind of thing. And but I don't have any dramatically new conclusions. I still think that things like asset swap spreads are still going to tighten. And I think for Italy, then that's the most seasonal, really, of all the the significant spreads that I monitor in this way. And we've already had a big move, of course, but I don't really see any reason to oppose that, as I've said in recent podcasts as well. And I guess alongside that, I guess I'm just thinking about the lessons of the UK, really, and whether in some sense the UK is a sort of microcosm, the test case, a little test tube with the UK in it, and if you sort of really put it under some stress and see what happens, and other larger economies in a more gradual fashion have developed similar kinds of symptoms. If that were the case, then what would be the right kinds of trade? I think really one of the ones there is it links to the thoughts about carry trades. I do wonder whether we can continue to see, for example, this outperformance of 10 years on the curve. Wondering whether that is a sort of all-weather type trade, but maybe there's a directionality to that that's interesting. So when I've more fully developed those thoughts, ask me again. But that's kind of how I'm thinking about things.
Lucky we have a regular forum for asking you these kind of questions. Okay, lastly then, there's a couple of other, I guess nothing surprising that you're watching out for over the summer, but certainly a couple of other more technical risk factors, let's say, that you're watching. Obviously, we have the big TLTRO repayment that we've talked about at length on this pod. We have the collateral reform story, potentially some political risk kind of rearing its head in Europe over the next couple of weeks. How are you thinking about all of those things?
Well, okay, so the TLTRO, as I've said before, the bottom line there is I don't think that it's going to be a massive issue. So let's see. But no, I'm sticking to my guns there. I think that there may be a need for Italy to try and bid back resources, and well, that is bank reserves, central bank reserves in the second half. But I don't think that is going to really put too much stress on the market in the next 10 days. So that's that one. Collateral reform. I mean, again, technical, but worth just remembering it's happening. In particular, the EU is the big one that's changing, although the changes are pretty small. So EU is now going to be treated as a sovereign by the ECB for collateral haircuts. But I think I checked this morning, over 15-year paper would go for something like a 7.2% haircut to, I'm going to get this wrong, but I think it's 5%. So it's not a massive delta. I think that if that matters, it's mostly just the signaling impact around that, the signaling that the ECB sort of endorses the EU as a sovereign from the perspective of liquidity and credit. ESM reform, that's something which is probably going to be bubbling away for a little while still, but there were some better noises just recently from Italy about ratifying that. So, it would be, I think, quite positive, really, for, not frankly for Italian spreads, but for sentiment overall, if they were to deal with that once and for all, and we could move on with the next steps in the very, very, very long road towards banking union. Political stuff, I mean, look, there are Spanish elections. We'll probably have time, we don't have time to talk about those because those are in July. But that's also important because Spain has the rotating presidency of the council in the second half of the year. And one of the big things on the agenda there is going to be fiscal reform, which doesn't look like it's especially imminent because Spain and Germany are still far apart.
Okay, great. Let's leave it there for this week. Thank you both for joining me. And thank you to our listeners for listening in. Just a reminder that if you liked today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks. See you next week.